Hi, it's Fred from CappThesis. Today we'll be discussing the significance of the trading ranges for the S&P 500 over the last 5 months. We're also going to talk about how important the next Fed meeting is for the market, and at the end, we're going to dissect the current relationship between the US dollar and Bitcoin. So let's get started, because the market really has been about moving sideways, breaking out, moving sideways again. And we talked about this in terms of calling these trading boxes. Now, we talked about Nicholas Darvis in the past. He wrote a fantastic book a number of years ago called How I Made $2 Million in the Stock Market. Definitely check it out. Talking about how he utilized this strategy. Quite simply, he'd frame the most recent price action in a trading box like this, buy it as it broke out, and then use the next trading box as a spot to take profits anytime that the stock would go below the most recent box, so forth and so on. So from using that type of strategy, we would have stayed in the market the entire time up to this point, because none of these trading boxes have been violated on a closing basis the entire time. And so, again, we know this won't continue forever, but we have to keep on respecting it for as long as it happens. Don't forget, there's been a lot of potential reasons for the market to pull back aggressively up to this point in any one of these times. And 3 of those events have been Fed meetings prior to the one that's coming tomorrow, March 20th, as of this recording. And so to review, this is what's happened on the previous 3 Fed days, where we had a 1% gain on November 1st. And remember, the market ripped higher from there. On December 13th, 1.2% advance led to, of course, another up leg before the market pulled back into the end of the year. And then the most recent one in January 31st, one of the biggest declines we've seen in a long time, down 1.6%. But what happened right after that? Followed by 2 straight 1% gains. And we can see how that pushed through box number 5, as we were talking about here, was January 31st, the next 2 days. And this is what really encompassed February's price action. Now, that's important because at some point, again, one of these is going to be resolved to the downside. And we saw that on the way up, where we had 4 straight trading boxes resolved to the upside. Looked like number 5 was upon us when that reversal happened. And of course, that led to the downturn that happened in the fall. And that's important because this was really predicated on the July 27th, really big outside negative reversal day. And remember, that came the day after a key Fed meeting, right here, July 26th. And these are all of the Fed meetings going back to the beginning of 2023, the most recent one, and all of the ones that are going to take place through the end of the year. And so, needless to say, I'm looking at this and thinking, well, this was a Fed meeting. It came after a very substantial rally over the course of a few months. This rally is even more powerful and longer at this point, and we come into the one in March after being told by Fed Chair Powell that we will not get a rate cut. So it's really about what's going forward and how the market receives it based on where we've come as well, up about 26% from that point. So all eyes will be on if this, again, is going to be an inflection point. And so looking at this from a short-term momentum point of view is going to give us a really good indication if things are changing anytime soon, because we've talked about this in the past and we continue to say, each one of these rallies up to this point has been at least 4%. The most recent one has been smaller than that, only 2.6% over the course of a few weeks, with the market failing to take advantage of another high-level consolidation. Again, very short term, but we've seen this play out before, where we got close to the 5,200 mark, couldn't quite get there, and now been oscillating underneath that spot for a while. So what that has done to short-term momentum is this, where we see that there's lower highs in the 14-period RSI on the 2-hour chart. The last time we had overbought from this very short-term basis was on March 8th, the day of the last intraday high for the S&P 500. And going back, there's been a time where we had gone longer without an overbought level, and that was from mid-December all the way to mid-January before the market took off once again. And so we know that momentum, it has been slowing, right? Things haven't really pull back in an aggressive way yet, because even though momentum or the RSI here hasn't gone overbought, it still has not gotten back to oversold. And that's the important part. This is what's really kept us in this move up until this point. As we talked about in the past, just waiting for this RSI to get back down to oversold and not doing anything else, just holding, would have kept us in this trend the entire time. So what does that say? Continue to hold until it's oversold. There's a rhyme there, but at the same time, that is what really marked the top at the beginning of August of last year from the rally from March. We talked about it before, but very important because these rallies are similar in many respects. Now, it doesn't mean when we finally hit that oversold level on a 2-hour basis that the end is here, right? And we're going to roll over aggressively like we did in the fall. Time will tell. There's obviously not going to be too much indication when exactly it happens at the time, but it's all about what happens after that. And really, that's why we rely on the pattern work so much, right? And from a long-term perspective, the RSI continues to be very high level, right? Mid-70s, which as we can tell, going back to late 2012, just hasn't gotten there many times. It takes a lot of very strong price action over an extended period of time to get to that point. And as we can tell, there's been periods when that lasted longer and got much more severely stretched. And that, of course, from late 2017 into early 2018, talking about a weekly RSI in the 90s, very rare. And that was right before the vol implosion again. And so what does it tell us? Now we can go back and look at the different times when this occurred. Again, worst case scenario is that this leads to much bigger volatility relatively soon and a much bigger drawdown that we've seen in the past. But we can also look toward what happened in 2013 when it hit 76. You could barely see a pullback here. Just really continued along the way up until really the middle of 2015. And again, same type of thing in 2021, hit 70s a few times, but still continued higher. And now we get to right now, where again, every time is different. We know that this RSI on a weekly basis cannot persist in mid 70s into perpetuity. It really is about what happens after it comes off of that very extreme level, right? Do we see a big comeback in? And again, we'll look at the patterns and see how they develop from that point to get an indication of how that is going to play out. Now, in terms of what's live right now, the only live pattern we have is the big one. 6,100 target. This does not look any different than we've talked about every week since. We just continue to tack on, higher highs and higher lows along the way and move slowly further away from the breakout zone of 4,800. And so it's going to take a good amount of pulling back in a much more aggressive way that we've seen to even get it back down there. But along the way, we'll be looking at the short-term pattern work. And right now, these are two of them that we are looking at. This is the same exact chart, both the 2 hours, starting at the same exact spot here, where anytime we have a digestive phase like this, short-term continuation pattern can develop or a reversal pattern on the bearish side. And as we know, all of the ones that have been working are continuation formations, whether they're cup and handle patterns, inverse head and shoulders. We've seen flags and pennants develop along the way, whether we're looking at the S&P 500 or something else. So right now, trying to do that once again, right? No different, just on a very short-term point of view. Whereas on the bearish side, we can see that there's a semblance of a potential rounding top. This could be, develop into head and shoulders or something else. The point being is, if this doesn't resolve to the downside, if we don't see a break of at least 50-50, then the same thing is happening. Topping patterns are failing. The big continues to be in play. You have to continue to wait for a momentum shift from positive to negative, right? And we know we're treating each one of these independently because eventually one is going to work. We're not going to sit here and say, the trend is, undisturbed and will never reverse. We know it will at some point, and we know we're going to get an indication from a pattern perspective when that finally occurs. Okay, and so looking at this from a weekly basis, just came off 2 straight down weeks. Not a lot, but different, of course, because we haven't seen that since the October low. And looking at this in terms of what it's done over the last 3 years is very instructive. Now, a lot of this may seem simple, but we have to keep the smallest things in our mind as well to help us through this type of market environment, meaning that in 2021, 2023, we didn't have a lot of long losing streaks. Only have 4 in 2021, 5 in 2023. The longest losing streak in 2021, which was very consistent, was just 2, right? It happened 4 times. Big came back in relatively quickly. In 2023, a little bumpier road because of the corrective action we had during, that from August through October. At the same time, there were only 5, and the longest was just 4. So, we can't expect every market to be, this non-volatile. At the same time, this didn't get much worse in 2023, where in 2022, a lot different story, 8 different losing streaks. So losing streaks of at least 2 weeks, with the longest being 7, right down in the spring into early summer there. And so again, no surprises in the best markets. You have fewer losing streaks, and those streaks are small. And conversely, there's a lot different story when you're in a bear market. Okay, so now let's look at the US dollar. And so it really hasn't done much this year in terms of scaring your risky assets, right? Because we had the rally from the beginning of the year, pretty strong, but most of the time, most areas that we looked at did fine. And one of the reasons was that it just wasn't that strong. And you can't really see it here, but on a weekly basis, we've been talking about it in our premium work at CappThesis, is that you have the weekly RSI not getting too much above the 50 zone the entire time, which was much different than what we saw in the biggest moves. And so even last year, we saw how when the dollar started to rally in the middle of July, obviously that had a very big effect on equities, and it kept the dollar's 14-day RSI in between the overbought level and mid-range, and that just kept the market, or it kept the dollar rising. Where since that point, it's been staying mostly below the midpoint here, and recently it's gone above it, but still it hasn't quite got to overbought yet. At the same time, now the pop off the low has gotten back to some key resistance lines here, right? The downtrend line, from the November top, and also a line that connects the breakdown zone from last fall as well. So this is going to be very important, because if this continues to make higher lows here and eventually goes through, that can have a big effect on risky assets, and we've seen it. And then, most importantly, if that then accelerates to the point when we saw back here into what we saw in 2022, that's when we know things can get a little hairy. That is especially true related to Bitcoin. Now, one of the things we've been talking about a lot over the last number of months was that there's a negative correlation between Bitcoin and the US dollar. And it was very evident back in the fall, where when Bitcoin bottomed in September, was up gradually, and that's when the dollar started to turn. And as it rolled over, Bitcoin sniffed it out first and started to rally. You recall in the middle of October, which was 2 weeks before the S&P 500 did. And really, Bitcoin has been leading the way ever since, as we know. And so dollar has been higher, Bitcoin has been higher as well through at least February. But as we can tell, it does better when the dollar is going down. And most recently, dollar strength has coincided right with Bitcoin pulling back after making new highs. So again, going back to the dollar, if it fails at that supply zone and continues to have trouble there, having momentum stay relatively tame, that could give risky assets, including Bitcoin, a tailwind to continue. Whereas if we see the dollar accelerate to the upside, which could coincide with, of course, rising rates and all that, if that really comes back, the momentum in both of those picks up, very important, that's when I think things can start to roll over, and some of the things we talked about with momentum shifting from positive to negative could take place. That's what we have for today. Don't forget to check out these videos and subscribe, and talk to you next time. Thank you.